Stablecoins quietly control where money flows in crypto, and most people completely ignore them. If you've ever wondered why the market suddenly rallies, dumps, or feels like it's stagnant out of nowhere, a lot of it comes back to stablecoins. In this video, I'm breaking down why stablecoins affect the crypto market and how they move behind the scenes. So before we go any further, let's make sure we're on the same page about what stablecoins actually are. At their core, stablecoins are just meant to track the value of the US dollar. One coin equals $1. That's the whole point. No volatility, no speculation, just a stable unit of value that lives on the blockchain. And that might sound boring, but that's exactly why they matter so much. Because most trading in crypto doesn't actually happen with people wiring money in and out of their bank accounts every time they want to buy or sell something. It happens inside the crypto exchange itself, and stablecoins are what makes that possible. A huge portion of all of crypto trading volume goes through stablecoins. When people are buying Bitcoin, selling Ethereum, or rotating into altcoins, or just even waiting on the sidelines, stablecoins are usually what are sitting in the middle of all of that. So instead of all the money constantly leaving crypto, it stays parked inside of that ecosystem. If I sell Bitcoin and move into a stablecoin, I haven't really exited the market. I've just stepped outside the risk for a moment, and I can step right back in instantly. This is what creates liquidity. It makes it easier for people to trade, easier for markets to function smoothly, and easier for price to move without completely breaking down. This is why stablecoins and major cryptos are very liquid right now. This is why stablecoin activity tends to increase when the market heats up. When trading volume picks up, stablecoin usage almost always picks up alongside it. There's a strong relationship there, and it's not hard to understand why. More trading means more demand for something stable to trade against. And sometimes changes in stablecoin activity usually show up when the price moves too. There's been research showing that when large amounts of stablecoins are issued, prices of major assets like Bitcoin often move higher shortly after. That doesn't mean stablecoins are some kind of magic switch that pumps the market. It's more like they represent a lot of volume that happens. New stablecoins usually mean fresh capital entering the system, or at least capital that's ready to be deployed. And when there's a lot of buying power sitting on exchanges, markets tend to respond to that. On the flip side, stablecoins also matter a lot when the market drops. During major sell-offs, people don't rush to buy back in with their bank accounts. A lot of the time, they rotate into stablecoins instead. You can see this happen in the data. During periods of market stress, stablecoin balances often increase. That tells you people are trying to reduce volatility without fully leaving crypto. It's similar to holding cash during stock market pullback. You're not panicking, but you're also not taking unnecessary risk when things are uncertain. That behavior can help slow things down. It doesn't prevent crashes, but it can reduce how chaotic they become. Now, when you zoom out, you start to see how big stablecoins have actually become. The total stablecoin market is now in the hundreds of billions of dollars. At that size, they don't just affect crypto. They start to interact with the traditional financial system too. Stablecoin issuers don't just keep all that money sitting around. They invest it usually in very low risk assets like short-term US government debt. Some of the largest stablecoin issuers are now amongst the biggest holders of treasury bills globally. And that's where things really start to connect. By now, crypto markets are indirectly linked to interest rates, liquidity conditions, and broader financial markets. When financial conditions tighten or loosen, stablecoins and by extension of crypto feel it too. Something worth mentioning that's actually happening right now is that governments are finally starting to treat stablecoins like real financial infrastructure. In the US, Congress passed a law called the Genius Act, and it was signed by President Trump. That gives a clear regulatory framework for how stablecoins can exist and be used in the economy. It requires stablecoins to be fully backed by dollars or equivalent liquid assets, and it lays out rules for transparency and risk management, something that the crypto market hasn't seen before. This is a big deal because regulatory clarity trends to attack institutional money, banks, asset managers, and payment processors, the kinds of players that need clear rules before they participate. That's why you'll be seeing more institutions and governments talking about integrating stablecoins into payment processors and financial infrastructures going forward. So if we're thinking about how crypto can grow from here, stablecoins are a part of that picture. By becoming more regulated, more widely adopted and accepted in everyday financial systems, they help bridge the gap between crypto and the real world. And all of that ties directly into liquidity, trading behavior, and long-term adoption. All things that can help the crypto ecosystem move past pure speculation and towards real utility. So the main idea I want to leave you with is pretty simple. Stablecoins aren't just background detail in crypto. They're one of the main ways money actually moves throughout the market. They influence liquidity, price behavior, and actually how crypto connects to the financial system. And once you start paying attention to them, the market stops feeling so random, and a lot of the moves that seem sudden or confusing start to make a lot more sense.